Hi, everyone, and thank you very much for joining today's webinar on Global Market Outlook. There are lots of themes that are shaping the markets going forward, and I'm pleased to say that we're joined by the very experienced and trusted partner of Carrick, Rob Enslin, who has done a number of webinars with us, and he's going to be unpacking, what's shaping the markets now, what we can expect going forward. It's going to be a 30-minute webinar. We're going to have a question and answer session at the end. My name is Anthony Palmer, Group Commercial Director for Carrick and also head up products and investments. A very interesting time period that we've gone through, Rob, and I think expect to go forward as well. What are your views?
Good morning, Ant, and good morning to all the listeners. First of all, I just want to say thank you very much for taking the time to be with us this morning. To really kick things off as a slogan, today's presentation is recovery, rebound, and rotation. I think that lies at the heart of the sort of thought process of markets at the moment, and certainly something that we would go along with. I think before we start taking a bit of a forward view, let's just take a step back and understand what has transpired in the first couple of months of this year. So what we're looking at here is really year-to-date performances, so from the 1st of January to the 14th of May. And what we can first of all see is that there's been a big change in terms of what sectors have under and outperformed. So if we took a snapshot of the similar type of view last year, certainly what was making the headlines and what was outperforming was what we referred to as the stay-at-home type business models, the likes of your information technology, business models where you could order at-home products. Fast forward to the first couple of months of this year, and there's been quite a clear rotation into almost the sectors that are connected to the economy. So if we look in detail first at the MSCI World, energy, financials, and materials have led the way. And on the flip side of that, you've had information technology, which has actually been the weakest performing sector over the short period in time. Similarly, if we break the market into factors, so we talk about value-orientated business models, and I'll touch a little bit more on that in detail further on in the presentation, or on the other side of the equation, growth-orientated companies. Certainly what we've seen is those deeper discounted, often more than not, more traditional business models coming through quite strongly at the beginning of this year and actually outperforming those growth-orientated stocks. And then lastly, what I just want to point out on this slide is that 2020 was a phenomenal year for fixed income in general. And what we saw was, because of central banks cutting interest rates near zero in developed markets, the response was a big capital appreciation in most fixed income strategies. Fast forward to this year, and as we're starting to witness some inflation concerns and with it bond yields rising, the complete opposite has really transpired. I would argue that was quite a telegraphed trade to take place, but yeah, in the first part of this year, there's been far fewer returns to be had within the fixed income space, and really the pain was held in the longer duration sovereign or government type bonds, if we had to point them out in that regard. Equally, back in March this year, we really got to the point where it was the 1-year anniversary of the now called the COVID-19 market crash, which many of you were unfortunately a part of during that period. But just to take some stock and really discuss a few points there, I think first and foremost, returns, or the dispersion of returns, were quite wide over the last year. The winners were clear winners, and at the same token, the losers were severe losers in that period. So if we take the MSCI World as probably the most broadly tracked example of developed market stocks, roughly 1,800 underlying companies, the winner over a rolling 12-month period ending in March was Tesla, returning just over 740%. Moderna, which many of you would have picked up in the news headlines, responsible for the vaccine, equally doing well in around 430%. And then even Zoom Communications, which we spent our last year on, clearly outperforming. Then on the flip side of things, a lot of industries that were negatively impacted as a result of COVID and were really forced to close their doors momentarily, the likes of leisure, travel, etc., Carnival Corp, under severe pressure there, down 56%, and then even something like Rolls-Royce, which we often associate with cars, but actually more importantly is the jet engines behind most of the aeroplanes that we fly on, equally suffering as a result of COVID. For me, actually, what is more important to actually just look at is the distribution of returns over the last year. And if we look at the charts on the right, and we package 12 months rolling returns all the way back for the S&P 500 back to 1957, the last year was the best period in history in terms of a rebound. So I think a key lesson there, and I'll kind of end my presentation later on with this point, but staying invested, regardless if you had the ability to pick the winning stocks or not, was probably your best outcome as a client. And that, I think, has shown itself over and over again to clients. Why have we seen such a rebound in markets? And I think start off was the vaccine hope trade, which soon became the actual reality of a vaccine, and now the vaccine rollout. And then coupled with that, which we've alluded to many times on these calls, is that central banks as well as governments stepped in very quickly and in a coordinated manner, which really created an underpin and still continues to create a very attractive environment for risk assets like equities over the last year. Fast forward to today, and what's become quite evident is that we're questioning whether we maybe potentially overreacted as central banks, and have we overstimulated markets as a result of that. Perhaps the best way to compare and kind of give a more meaningful understanding of that is to compare the financial crisis and what central banks and governments did during that period compared to what we've just recently witnessed and continue to see in the markets. So first and foremost, if we look at the fiscal response, so government spending as a global percentage of GDP during the financial crisis, that amounted to roughly around 6%. This time around COVID-19, and the numbers still running at 28%. So, I mean, we're looking at 3-4 times the amount of fiscal support over that period. In terms of asset purchases and almost creating liquidity in markets during the financial crisis, that was around 8% of GDP. This time around 15%. And then we talk about permanent unemployment. So jobs that have been really lost, I don't want to say forever, but structurally lost. And if we measure 2008 financial crisis, that was estimated at around 7.1%. This time around 3.7%. Equally, if we look at some more harder data that's understandable to many clients, if we look at bankruptcies filed in terms of the US, and we look at C11 filings, there's around 4,300 during the crisis, this time 2,200. And then lastly, personal income. We saw people actually, in absolute terms, lose the amount of money that they had in their hands compared to prior to the crisis in 2008 by about 6%. This time around, oddly enough, there's actually been a growth in incomes of around 14%. And those are those stimulus checks that we've seen the Fed and government sort of implement in the US that found their way into the consumer's hands. So really what we're looking at today is a market where, yes, COVID-19 continues to play havoc on societies, and from a social point of view, a serious problem. We're witnessing terrible statistics and numbers coming out of the likes of India and parts of Asia at the moment. But from a pure market perspective and what the risks today are, we can see that we've moved on somewhat from COVID in terms of the key risks. And we're starting to think about inflation becoming a more and more important risk. So what we're looking at here is really a chart done by Bank of America. It's a global survey where they really send out to various asset managers who fill out what they think are some of the bigger risks. And you can just see in terms of the darker blue shaded charts by the end of March compared to February, how higher than expected inflation, first of all, became in absolute terms the biggest risk. But the extent of the change, and then if you compare that to the third line item, being COVID-19 vaccine rollouts, etc., the mood of the market has changed a little bit compared to a year ago in this regard. So really what I'm going to jump into in this part of the presentation is to try and identify some of the key global investment themes that are really shaping markets today, and will continue to create headwinds and tailwinds as we kind of approach the second half of 2021. So first and foremost, global economic rebound. To kick off this conversation, what we've seen from various different agencies, measures of economic growth, we're looking at the IMF. The key takeaway from our point of view is each time they come out with a statistic or an expectation, they upweight or improve their growth estimate for the year to come. And so this is the central theme in markets. We are all expecting a stronger second half of 2021 with some follow through in 2022. And that in itself, in my mind, is a risk, because markets are already partially pricing in higher growth expectations, and therefore we need to deliver on those sort of outcomes. Equally, what has become quite clear as time has rolled on is that we're seeing the haves and the have-nots in terms of countries. So the big buzzword last year was about the K recovery, and it was more referring to certain sectors outperforming others. I think that K recovery still applies, but it now applies to countries. And if you all else equal, we'd argue that developed markets, because of a more successful rollout and access to vaccines, are likely to see stronger rebounding growth or an improvement in terms of business activity in the second half of this year compared to emerging markets. So when one is looking at economies, or from an economic rebound perspective, I think we do need to take a step back and firstly appreciate sort of the medical interventions that have played out over the last 15 months and continue to play out. Secondly, things like the effectiveness of policy, the size of stimulus that they've been able to apply to markets. And again, I think developed markets to many emerging markets find that a lot more challenging for emerging markets. And then we do need to be long-term focused, and certain economies going into this pre-COVID and post were structurally more impaired than others. And those impairments were almost amplified as a result of COVID. And so these are the type of things that we need to consider when we're looking on a geographic perspective. I think probably the biggest risk, which we've touched on, is inflation concerns and the market's thought process in that regard, and whether we have overstimulated. The point here is that we are going to see higher inflation. COVID really resulted in a global slowdown or shutdown of economies, and as those economies get going, anyone, I think, would be fair to argue that higher inflation is expected. The question we really need to get our heads around and get right is, are we going to see rampant, higher than expected inflation as a key risk for the markets? Because remembering that this very accommodative environment that we've just painted through stimulus, whether it's through central banks or through governments, is based on the premise that it can continue for some time to come, and that accommodative environments in place. If we see higher inflation, central banks will be forced at some point to defend that through raising interest rates. And that will really be like pulling the rug out of markets. Hence why we're also concerned about inflation over this period. On the one side of the equation, if we look at the bond market, which really prices in future expectations of inflation, we had the worst quarter in the global bond market since the 1980s or early 1980s. So the market, particularly from the bond side, is disbelieving. And then to the flip of that is really the central banks led by the Fed saying that we are going to keep conditions as low for much longer than the market is pricing in, and that yes, we are likely to see some inflation coming through, but it's transitionary, it's not structural, and therefore we just need to let this play out because of the likes of base effects, etc. So this is one that we are watching closely. The latest inflation data that came out of the US was a surprise to the upside. On a rolling year, it was 4.2%. And on a month-on-month basis was 0.8%. So that was a lot higher than the markets really thought was as an expectation. A consensus trade going into the beginning of this year was dollar weakness. Because of the amount of dollars that have been printed, the outcome of that is supply-demand dynamics, meaning a weaker dollar. And that certainly did start to play out quite strongly throughout 2020. What was quite an interesting and I think a sort of point to mention and did catch markets off a little bit off guard was sort of a bottoming and a slight strength of the US dollar. And really what's happened there is because of higher inflation expectations, US bonds have started to price higher interest rates into them. And if we compare US bonds to other very safe haven type bonds, the likes of your German Bundsbauer, for example, you've seen that relatively more attractive yield in US, and as a result, the demand, all else equal, for dollars has picked up. And that's just, again, an early something to be aware of, not right now out of control, but it does derail that emerging markets thesis if this gains some more traction and some legs. One of the big sort of rotations that has happened quite quickly in markets in the last sort of got going from November last year is the switch from growth-orientated business models that have a strong growth factor to them, to more value-orientated business models. And to explain a value-orientated investment philosophy, the objective there, all else equal, is to buy a business that is trading below its fair value or intrinsic value, deeply below that value, with the belief that over time the market will come to its senses and realize that fair value on behalf of clients. And it's not exclusively, but often more than not, a lot of value-orientated type business models find themselves in traditional industry, the likes of materials, the likes of your industrial sectors, your consumer staples. Those are often where you find these value-orientated stocks. What we've seen and I showed earlier in the presentation, is that there's been a strong rebound in certain sectors, the likes of your energy, your materials, your financials, which many of those stocks would have been classified as value-orientated business models. To provide a little bit more context to this debate, and we've been in a strong decade where growth has outperformed value, and many investors would be caught up with sort of that belief. But if we take a longer lens on markets and go all the way back to the early 1930s, value for most parts of the last 80, 90 years in markets have actually outperformed growth-orientated strategies. But really, to unpack that a little bit further, I think we've gone through structural changes through society over the years. So back in the early 1800s, which was cutting edge then, was the development of financial systems and with it businesses as well as real estate, which then moved on to the Industrial Revolution, which was supported by transportation, and a large part of the middle parts of the 1960s all the way to the sort of 1990s, we saw energy and materials companies dominate in terms of size and performance on various indices like the S&P 500. The last decade, which has, if anything, been accelerated as a result of COVID-19, has been information technology and communications. New technologies have enabled new ways of doing things, and a lot of those businesses have become self-fulfilling in terms of demand from clients and access to markets. And that many of those business models today are classified as growth-orientated businesses. Another key theme has been the revival of commodity prices, and from a South African perspective, it is certainly one of the inputs as to why we're seeing some rand strength of late. The terms of trade for South Africa have become quite favorable quite quickly in that regard. And that's been led by the US talking about an infrastructure spend bill that's been put on the table of around $2.1 trillion. The idea there is to improve the US's aging infrastructure, and as a result, create a more sustainable long-term input into employment and recovery for the US economy. That deal has not been passed per se, but it has been put on the table, and really, all else equal, that is a good underpin for emerging markets, particularly emerging markets that are ingrained with commodity-orientated business activities. The likes of Brazil, the likes of South Africa meet that definition, and partly why, along with the recovery that we've seen, the global recovery, this underpin has supported commodity prices, the likes of your copper, the likes of your iron ore, that have gone on to make record highs of late. And then perhaps another question that I've probably been asked the most this year is the market in the bubble? Is the market in a bubble? And traditional assets also performing well, but then we've also seen the things like cryptocurrencies also going on to really perform well, and hence markets asking, are we in a bubble? And to start that debate off, I thought we'd look at a CAPE ratio. So for the viewers who don't know what a CAPE ratio is, it's a cyclically adjusted PE ratio. So what we do is we look at the prevailing price of markets divided by the last 10 years of earnings. So it takes out these jolts in terms of earnings that we often witness on a one-year period. And if we look at the CAPE ratio relative to history, it is the second most expensive it's ever been. And why the CAPE ratio is important is that, historically speaking, it has always been a good measure or a good predictor of when the markets have become very expensive, which has subsequently led to some of the crashes in the past. The likes of 1929 screamed quite expensive back, and then again in 2000. And if I left the presentation there, I'm sure many of you would be quite concerned and sort of run for the hills. But the reality is, the big caveat or the difference compared to previous periods is where interest rates are today. So if we almost take that CAPE ratio and divide it by interest rates, the picture becomes quite different on that metric. Secondly, I thought let's dive into what makes a market bubble. And the chart on the left-hand side, I think, is very interesting. A deep research piece done by Goldman Sachs looked at some historic bubbles all the way back to the sort of 1600s. And while each bubble is quite unique in what has driven that bubble, what is quite similar in many cases is the timelines. So despite bubbles being different in terms of its design, human nature, greed and bust often behaves in the same way, and therefore the timelines are quite close. So typically speaking, a bubble has almost a 1-year ramp up of extreme performance and takes about a year to unwind to the bottom. Secondly, what are sort of the key ingredients if we study previous bubbles that were at play at that point in time? And some of the 9 points there to make is, firstly, excessive price appreciation and extreme valuations. There are parts of the market that I would say tick that box. Secondly, new valuation approaches being justified. I wouldn't say we've really moved into that space if we look at the likes of traditional markets like the S&P 500, but certainly I've heard some interesting debate when we talk about the cryptocurrencies in that regard. Secondly, increased market concentration. So the larger companies become bigger in indices and smaller companies kind of fall by the leeway. Fourth point is frantic speculation and investor flows. So people feeling as though if they don't get in now, they're going to miss out. And we would argue that investing is a long-term journey, but during these times where performance is so strong, we understand why clients feel that they need to make a decision very quickly. Fifth is the easy credit, low rates and rising leverage. And I think, again, a lot of those ingredients are at play at the moment. The world is very cheap in terms of risk assets, ability to access them. And then various platforms have also made accessibility a lot easier over this period. Booming corporate activity. So I don't think we're really seeing booming corporate activity yet, but we are starting to see some green shoots and improvements as we move out of COVID. A new era narrative and technology innovations being adopted, and we've been on that trend, I would argue, for the last decade. Late cycle economic boom, and that I think derails the whole belief of why we might be in a bubble at the moment. We're in the early stages of a cycle, so that alone is probably the strongest point why there could still be more room to move and why we don't believe we are quite yet in a bubble as a market. And then finally, the emergence of accounting scandals and irregularities are often come along with the late stage of the cycle, which often suggests that we're nearing the end of a boom or a pop in the markets. So really, and I alluded to this slide, but despite all these sort of risks that I've just mentioned as investors and things that we need to think about when we're taking decisions, the most powerful tool that we have as clients is time. And really that's shown to be true over the last 15 months or so in markets and through many other crises. If you study them, the most sensible thing would have been to stay invested. And despite some of these risks certainly starting to emerge in markets, we're strongly encouraging our clients on behalf of advisors to stay invested, make sure you're in a strategy that makes sense relative to the risk you're able to take on. But if we just take a look at the S&P 500 and we go back to the 1930s and we break it up into decades, and we create a few scenarios. And I really had to rerun this exercise because at first glance it seemed too strong to be true, but it also lies at the heart of the power of compounding. But if one had invested in the S&P 500 back in 1930 and just did nothing, really left your money there for the last 90 years, in most cases you would have inherited that from your parents, that return, because of compounding today, would have been 17,700 odd %. If you were someone who tried to time the markets and almost wait for the green light and stay away from markets when there was known risks, and were that unlucky person who missed 10 of the best days in each decade, your 17,700% return would have been diminished all the way down to 28%. And really, you would have done better in cash during that period, all else equal. Obviously, there are the other flip side of the coin would be someone who was able to predict the best 10 days and just stay invested there, and your return would be a phenomenal 3.8 million odd %. But our argument is that most clients don't have that ability. We certainly don't have the ability as an investment house to know when every day is going to be a good or a bad day on the market. So the point here I'm really saying is, despite there will always be risks in the market, but stay invested. And the only way one can stay invested is to be in a suitable strategy relative to your ability and willingness to take risk. And lastly, just to put this all together in terms of a global outlook, markets are certainly expecting a better second half of 2021 with some follow through in 2022. That is the core belief and certainly what we are going with. But as I mentioned before, that does create risk for markets if it does not quite play out as expected. Don't lose sight of the fact that there continues to be significant support from central banks and governments in play. They have not taken their foot off the throttle as of yet, and the environment that we're currently going through is highly accommodative for risk assets like equities. And that's been further bolstered with the rollout of vaccine programs across the world. Yes, there's been certain countries that have been more successful than others, but the general view is that the rollout process is gaining more and more sort of traction and likely to be quite an input to this K-shaped recovery that we're talking about. Whilst the Fed and other central banks continue to tell us that they are here to keep conditions quite accommodative for some time to be, and markets sort of pricing in higher inflation is premature, we do need to continue watching their language, and that is something that we as an investment house are watching closely as early warning signs for them ultimately to start raising rates. This reflationary trade, which I've spoken about, has created a ripple through markets. It has created a rotation out of some growth-orientated business models into value-orientated business models. It also has created momentarily a headwind for your fixed income type strategies. We are measured in this approach. We're certainly not moving in one direction. Whilst we appreciate some of these dynamics at play, we do continue to favor high-quality business models that are growing with a long-term trajectory of growth expected for the next decade. So we're certainly not completely rotating the portfolio as a result of that. And then just something that I touched on as well, this recent strength in the US dollar. And we don't really see it as South Africans because interestingly, the Rand has actually been the strongest performing emerging market in the world year to date. So it's kind of been masked against it, but some strength in the US dollar also has some ramifications for emerging markets and commodity prices, all else equal. And then really just because of all of these dynamics taking place, now more than ever is important to make sure that you're measured. We remain positive towards risk assets, but we are appreciative of some of the risks. And as a result, we're saying remain measured in your investment decision. Now is not the time to sort of drift into higher risk profiles than what is suitable to you, but at the same time, not panic and get into something really defensive, because ultimately that will erode your performance after inflation for years to come. So that's my story, Ant, and I thank you for listening to all the viewers.
Yeah, perfect, Rob. Thank you very much. I mean, as always, very, very concise overview of the markets. I think you managed to hit all the main points. I was just looking at some questions that were coming through. One point that you know, as you know, we have a lot of South African listeners, and a couple of questions have asked for your view on the Rand. Now, that's, as an advisor, that's not an easy question to answer, because there are so many factors to consider. But you know, once we have you here, your view would be appreciated.
Yeah, so I think first and foremost, important for the listeners to appreciate that the Rand, if you had to compare it to other currencies, is very cyclical. So we've always said the Rand is a price taker, it's not a price maker, and some of the external forces often drive the Rand. And what we've seen is because of higher commodity prices, some tax collection improvements locally, all else equal, the terms of trade have quickly become quite favorable for the Rand. That coupled with, and we're not really seeing an inflow yet from foreigners into our bond market, but our bond market relative to other bond markets offering quite attractive yield, are all sort of factors that make the Rand quite attractive as we're sitting here today. But as much as the Rand has quickly strengthened, we know that it tends to over and undershoot. And because of the cyclical nature, as a long-term 10, 15-year expectation, we still think that there's some major headwinds facing the South African economy. We have a structurally weak employment sort of design in terms of some of the red tape that we face. We have a lot of debt on our balance sheet that we really need to work our way through. So those sort of longer term trends still need to play through the Rand. Short term, not surprised that the rand has strengthened so much, and it could continue to strengthen. I think the sort of next level that the market is looking at is around 1380. But as quickly as that can kind of play out, it can snap back against you. So what we're saying to our clients, if you're looking to build a well-diversified portfolio that has global exposure, remembering that South Africa is a tiny part of the global economy, now is quite a good time to make use of the strong rand to externalize your investments.
Thank you for that. Trade wars between the US and China were, really spoken about at length. Wasn't included in your presentation.
Yeah.
What's happened in that space? Life has no side mirrors. Could this be something that catches us all by surprise?
Yeah, so I didn't include that, and certainly something that is slowly brewing in the background. And if we jog our minds back to pre-COVID, that was sort of central to the ebbs and flows of markets and the mood of markets, and ultimately a trade deal was reached between the US and China in January. Subsequent to that, we've had a change in guard in terms of leadership in the US. And whilst I think they're a lot more eloquent in terms of their negotiations, they've made it quite clear that their views and honoring of that trade agreement between the US and China are still important in terms of the new administration. And as things stand right now, Chinese imports of American goods is running well below the run rate and in the deadline that was set for future. So certainly can start becoming, I think will become a more spoken about risk in markets in the second half of this year. It will be interesting to see how negotiations take place between the two countries. It's not immediate risk in our view, but certainly one that we will be keeping an eye on as things sort of get closer to that deadline in terms of what was negotiated under the previous administration.
Perfect. Another question has come through on Bitcoin. You did mention it a few times in the presentation, but just your views on crypto, I think, in general.
Yeah. So first and foremost, want to point out that cryptocurrencies in South Africa and many jurisdictions are not yet regulated. So in that regard, the views that I'm sharing here are just common views in the market. There are some favorable factors from a Bitcoin point of view. It's often spoken about as an alternative to gold. If you look at its correlation qualities relative to other asset classes, if you're building a well-diversified portfolio, you could argue on those reasons that it creates some diversity in your portfolio. And I think the big change that's happened over the last year is that it's been institutionally adopted by some qualified investors, hedge fund strategies talking about it. So those are some of the strong forces behind Bitcoin. And then you've had some media attention, the likes of Tesla buying Bitcoin earlier in the year, $1.5 billion odd. I think, though, if I really take a real short window in the last week and a half, a lot has been thrown at Bitcoin. So first and foremost, the US regulators talking about investigating Binance, the biggest cryptocurrency exchange in the world. That was the first sort of challenge faced by Bitcoin. Secondly, Tesla saying that they're no longer going to accept Bitcoin as a means of payment because of the sort of environmental impacts in terms of mining Bitcoin. And then lastly, the Colonial Pipeline, which we've just witnessed in the US, that was hacked and momentarily stopped. There was a ransom paid with $5 million odd of Bitcoin. And I think that's just once again raised authorities' ears that the misuse of Bitcoin, money laundering, terrorism, etc., obviously makes Bitcoin as it stands today a lot more risky than traditional currencies. And if anything, the need for regulation in that space needs to be stepped up. How that impacts Bitcoin, I'm sure it will create some volatility. Structurally, long term, I'm quite for a regulation, but in the short term, that could create some volatility in Bitcoin for now.
Great, fantastic, Rob. I think let's leave it there for today. Once again, thank you for your time. To our listeners, thank you very much for all joining. I hope that you took something from it. If you do want to have further discussions about your financial planning, about your wealth management, please contact your Carrick advisor or email at wealthmanagement@carrick-wealth.com. Otherwise, have a great day further and looking forward to speaking to you again soon on another market update.